Mehra is with us. She's a market master of the day, founder, chairperson, and managing director at First Global. Devina, good to have you with us here. Thank you very much. Simple question: did the low that we saw yesterday, is that like a major bottom, or is it a temporary one in your opinion? And of course, I mean, some of the events recently.
I would think it's a temporary bottom.
Okay. Okay, go on, sorry.
There could be a pullback from here, but then there could be a further correction also. So, I mean, if you go back to what I've been saying for the last few months, we had been expecting some sort of correction, but I do not foresee a kind of sustained crash, at least on the large cap and mainstream indices spaces. And as of now, our systems are showing that the small and mid caps would tend to be a little weaker than the large caps.
So what's the roadmap from here? I mean, very hard to predict near term what happens, but in the broader framework, maybe, a bit of pullback on the higher side, and then a revisit back to where we were yesterday and maybe even a little lower. Is that what you're calling for?
That's the likely scenario, though, as you said, in the short term, it's very difficult to predict. And we have been little cautious for the last 6 months. So it's not as if, I'm saying this just now, as right from March, we were hedged. We were hedged going into the election results. We are still partly hedged, but of course, a lot of those strike prices have are further away because the market has actually done very well in the last 6 months overall. I mean, there were periods of volatility, but eventually it did well, and which is the reason we never made a cash call. So while we did buy hedges off and on, we never made a cash call because we were clear that there is not going to be a sustained crash. It is just that you have to be in the right pocket. So we moved away, for example, from the very small caps, the 1 to 5,000 crore market cap band. We moved away a lot more than, normally we have like 13-15% there. We went down to 5-6%. So those are the changes we made, but we never felt that there was any need to go into cash because there's always a risk of missing out an up move if you are in cash. And as we've seen in the last 6 months, we have seen that up move. So, if we had acted on that caution by going into cash, that would not have been a good call.
Hi, Devina. Good morning. Always good to see you. Devina, I recall when you got the timing of Tata Motors correct. I'm not sure whether or not you'll have exposure right now, but we have another big IPO that's coming in, the Hyundai IPO. And from a market perspective, a lot of liquidity could go in there. But what's your view on this particular IPO? Because it's going to be coming not at a very cheap multiple. We already have some peers that are trading at a bit of a discount. Your approach to it?
We normally do not either apply for IPOs or, for that matter, buy just after listing. I think there's always plenty of time to do a proper analysis and get in when we need to. So, I mean, I don't particularly have a view directly on the IPO as of now. And while we are overweight on autos, it is not so much the manufacturers. It is mostly the component manufacturers where we have more exposure. So that's where we are positioned. Now, of course, we are in the middle, in another 7-10 days, we would have done a rebalance, a quarterly rebalance. So we'd have a clearer picture of what our systems are saying right now. But this is where we are currently.
Give us some names, auto ancillary. What do you all have?
We have a range of auto ancillaries. So that's a sec. I mean, we do have we do have two-wheelers, we do have four-wheelers, but I'm saying the skew is a little more towards the ancillaries.
Oh, okay. Devina, hi, morning. Great to have you on the program. So I want to ask you a very simple question because there's so much moving in the world, right? From wars to which central bank is cutting, which one is hiking. But for once, and let me add a caveat for this question. The caveat is nothing very dramatic happens. There's no US recession. There is no big, breakout of war in the Middle East. Everything remains status quo. If you were to design a brand new portfolio today from scratch, allocating fresh money, how would you do it and what all would go into it? I know you like pharma, you mentioned some auto, but a brand new portfolio starting today.
We always look at it as a brand new portfolio, Surabhi. That's the philosophy, that every quarter we look at from scratch what looks the best now. Because otherwise, if you start from your existing portfolio, there's something called an endowment bias, that you will value something more simply because you hold it, and it holds for very simple things. Even a coffee mug you will value more if you are holding it, if you have it, rather than when you don't have it. So that's very clear. I mean, I say the only reason a hold rating exists in the world is endowment bias, because anything you will not buy today, you should not hold. It is very simple.
Yeah, I agree, Devina. And that endowment bias, for instance, like if you have Trent in the portfolio, the world looks like a good place. If you're still riding, the PSU rally, and if you made like 4x, 5x on a HAL, you have a very different perspective on the world, right? That's why I asked if someone has to make a fresh portfolio today.
That's why you need a system to remove that kind of bias, that human element from this kind of analysis. So that's why we say, like, our first cut is what the machine says. And it works both ways. I mean, in 2021, no one wanted to look at capital goods and industrial machinery because that had been a disaster sector for 12 years. And the human fund managers did not look at it for another 2 years. Whereas we went overweight in October 2021 because that's what our systems showed, and our checks showed that yes, this industry will do well. So you forget about the fact that it was a dog for 12 years and now it's going to do well. So we were overweight all this while. Now we are, of course, close to market weight, just slightly overweight. Where we are still considerably overweight also are pharma, IT. So cap goods, as I said, is now close to market weight. So, pharma and IT would be where we are overweight, and auto components I already mentioned. So those would be the pockets as a pattern. We are looking at FMCG. I can't say that, we are not overweight yet, and we've not made a final call, but I think the crude prices going down and likely food prices also going down means that FMCG two factors actually improve, because for one thing, their input costs are like things like oil and also the crude downstream. So that goes down. And also if food prices go down, then in the household budget, there will be more room for FMCG, because right now the food inflation has been meant that food has crowded out the FMCG volumes. So those are things we are looking at. But as I said, as of now, we will be overweight auto components, pharma, IT, slightly overweight cap goods. So that would be, and now last rebalance, while we may not be exactly overweight, but we've added chemical stocks after 2 years. So that was one thing which we added in the last rebalance.
Got it. Devina, we've got a mega IPO, right? The Hyundai IPO, which is here. I remember long back, maybe in the early 2000s, you had written a report on cross-country comparisons and why they don't make much sense. And I remember this example, maybe, I don't remember exactly when, but it was one of those very, very well-written notes, and I hope you do more of that, and maybe put some of those older reports online, because they're
some
key
of
to
them,
read.
yeah, some of them I have. This was like a story of cross-country comparison.
Yeah, so my question, Devina, is,
right.
this, a lot of commentary that maybe, Hyundai in Korea trades at 5 PE. Why should it trade at whatever 30, 40 times it is coming to the market here? You can make that same kind of argument for a lot of stocks, a lot of companies. But just your thoughts around this one for you viewers in terms of an actionable way. Go on.
So, I mean, IPOs, I'm not, IPO, the problem in India in the current scenario is this, that you either will get stocks which don't make sense if you go into the fundamentals, or stocks which do make sense, you're unlikely to get much allotment. Excuse me. So, therefore, what people are doing is that they are not really taking a call on investing in a company. They think this is some kind of investment in a IPO process, as another fund manager put it, that so it is like a lottery that you are playing. So that's, IPOs are a strange animal as of now. So when markets are not that good, then you can actually properly evaluate and invest in an IPO or not. I mean, as I was pointing out to someone who was talking about whether someone's parents won an allotment in the Infosys IPO. And I said, do you know that it was an undersubscribed IPO that actually devolved on the underwriters and eventually made a lot of money for those underwriters. But coming back to the cross-country bit, see, the PE of a stock is determined by three things. One is the cost of capital, which means the risk-free rate plus the risk premium in that particular geography. So, I mean, interest rates around the world differ. Then the other thing is the growth. So again, the growth rate in Korea and in India may be different. And the third thing is the return on equity or return on incremental capital, to be exact, those are the things that determine the PE trajectory. And India, unfortunately, never gives you a free ride. So in India, always, as you said, most MNCs trade at a much higher multiple, and which is why, in India, you cannot have even a dividend deal kind of strategy, because anything that pays enough dividend always trades at such a high premium that you, on the market price, you don't get much of a dividend deal. So, that's the way it has been.
Absolutely, Devina. We're a country of bright-minded, what is it, last count, I think 1.4, almost 1.4 billion, right? So, things don't come easy or cheap in India. Pleasure having you on the show this morning. Thanks for joining in, and we look forward to the next conversation.